Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is April 6th. It's a Wednesday. Today we get the minutes from the FOMC meeting that occurred last week, and the market is not liking what the Fed is saying about raising rates. It's interesting, but the market seems to be back mostly focused on interest rates and not the war. It seems like the war has been assimilated into the economy, but we are down quite a bit, a lot more on the NASDAQ than we are on the Dow. The Dow's only down 200 points. NASDAQ's down 200 points, but the Dow has a value of 34,000. The NASDAQ only has a value of 14,000. Now, as I said yesterday, I'm watching this area very, very closely in the bond market, and it looks like we broke it yesterday. That means interest rates are set to go higher, which means there's more pressure on stocks, which is one of the biggest reasons why the stock market fell apart yesterday and why it's opening up lower this morning. So again, you got to watch this level. The lower the bonds go, the more pressure there is on interest rates or the stock market. The more, not interest rates, the lower bonds go, the higher interest rates go, and the higher interest rates go, the higher pressure there is on stocks, because stocks and high interest rates, they don't get along very well. Put the call ratio, I got to say, it's at 95. Anything around 95, 110 is telling us that the number of put buyers is grossly outweighing the number of call buyers. The problem with that is that scenario doesn't sustain itself, and usually it's mean reverting like the market. So because the number of put buyers is so high, I'm actually looking for the market to go higher and not lower. Volatility is past 20. It's higher than 20. It looks like it's rallying again. I don't think we're going to hit 35 again. This is when the war started. I think we may go up to about 25, 30, and then we'll go ahead and sell it at that point once again. But right now it needs to get a little bit more elevated before doing so. And let me show you something interesting. Now, if we look at the major sectors, and I want to look at the major sectors right now, you still have energy, utilities, basic material, consumer staples. You need to stick with these. There's a lot of upside recently on consumer discretionary. And look at it. It's already in third place. But remember, it's fragmented with technology right now. So you got to be careful. And remember, this is only on a 1-month basis. But look at this, 6% over a month versus utilities at 8% versus real estate. I mean, this is outperforming over the last month. Discretionary stocks are outperforming consumer staple stocks. That's very, 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 very positive. And that's telling us the market really wants to go higher, and it's bucking the natural inclination of rates going higher and sinking the market. Now, with that said, let's look at some levels. Actually, let's talk about global economy, and then we'll look at some levels. Federal Reserve officials' comments fueled expectations of a more aggressive U.S. rate hikes, and the White House announced more sanctions on Russia. Now, today, we're going to have the FOMC minutes from the meeting that happened last week. It'll be interesting to get an inside view of what the Fed is thinking, but it seems like the bond market's already right there. As you could see, it's already reflecting within its price that interest rates are going to go higher because bonds are going to go lower, and the fact that the Fed is going to probably raise 0.50, not 0.25 basis points. So oil prices rose more than $1 a barrel. It would be foolish for us to think that the rally in oil is over, because the war is not over and there's so much unforeseeability right now. The White House said Western government will ban new investments in Russia following evidence that soldiers deliberately killed civilians. That's no good. The U.S. Treasury said President Putin government will be blocked from paying debts with dollars from financial institutions. But that's potentially increasing the risk of default, which is not going to be good for anybody. Because remember, Russia is still a global economy. Traders are pricing nearly a 78% probability that the Fed will raise its key rate by 0.5 percentage point, which is what's ruining or roiling this market right now. At its next meeting in May, that doesn't happen till next month. That would be double the usual margin of change, and a step the Fed hasn't taken since 2000. Higher interest rates tend to hurt stocks that are seen as the priciest, which puts the focus on big tech and other high growth stocks like consumer discretionary. Apple, Tesla were some of the biggest losers yesterday. On Wednesday, that's today, the Fed is going to release the minutes from its March meeting. They'll probably confirm that the Fed wants to raise rates 0.5 basis points, and typically the day the Fed has the meeting, the minutes meeting, the markets don't do well. They do well afterwards, however. Bench oil, crude oil rose again. Now we're at $103 per barrel. I wonder if we're going to get back to 120. If you look at the energy sector, let me show you something here, which is up pretty good this morning. You will see that it's been consolidating and congestion. Although it's looking higher right now, this consolidation will cause some volatility, and this is a lot of uncertainty of whether or not this is the peak. But based on what I'm seeing right now, and based on the fact that this war is nowhere near over, there's a good chance we may get more upside from the energy sector. Looking at the NASDAQ, let's take a look at the NASDAQ, which is down quite a bit right here. If we stay around this level, maybe cool off a little bit, it won't be too bad because, look, we went from 315 all the way to 370. It's normal to have a little bit of a pullback, especially if we start going higher. But if we break this and start breaking down, it's not going to be pretty. And we're seeing some indication of that from the semiconductor index that's already lower. But again, I don't know if we're going to break lower, but I think will be the lowest we'll go, and we'll continue trending within the channel that we are building right now, which is right here and right here. So we may be kind of moving along this line in chip stocks for quite some time. Now, S&P 500, which has been the strongest sector because it's got some of the tech and some of the discretionary, it's literally at the 200-day moving average. So we got to watch it very, 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 very carefully today, especially in light of the fact that the bond market broke below our support level right here, our little box right here. So we got to be very, very careful. I would love to see the S&P back above. It's hard for me to imagine that the S&P is going to go from 415 to 462, knowing we're going to have rate hikes and come down and destroy all of those gains because the Fed is planning on doing what they've already announced several months ago. So it'll be very interesting to watch today's session. Now, remember, today is Wednesday, and Wednesday, I always give you guys actionable trade ideas. So I'm going to do that right now. So for the long side, let me give you a couple of good ones here. I want to give you guys stocks that are not overextended. Yeah, Merit, look at energy stocks. They really took a dump yesterday, but I think today they're going to recover. ADM. I like ADM. I think ADM is going to go higher. I would be buying it right around the current levels with a profit target of about 93. ADM, I like this stock right now, and I think it's going to do real, real well. That's to the buy side. To the sell side, let's look a little bit to the sell side. Stocks are really mixed up right now. This STVN, let me look it up, STVN. Stevonto Group, yeah, it just doesn't look all that great. It's been in a real strong downtrend. It's already breaking ground. There's a good chance it'll come back down to its base of about $15. But STVN to the short side and to the long side, ADM. Let me pull that up for you right here. ADM. That's a great stock to own, and I think the stock is going to go higher. And again, if you look at what the stock does, it's not a consumer discretionary stock. It's a consumer staples, fats, oils, agricultural operators, 58% a year. Russia, 30% Europeans, agricultural market. So definitely a good reason for these stocks to rally. Now, before I let you go, the Federal Reserve, folks, they're set to continue raising rates, and a lot of money is poised to flow into and out of various sectors based on that news. Sector rotation is not only one way, but it's one of the ways that allows us to take advantage of upside momentum. But one of my best strategies includes a hedge that has allowed us to protect ourselves from volatility in downside markets like right now. It's the best of both worlds, all while volatility in individual stocks is present. Right now with volatility picking up, VIX rose 14% yesterday. Markets are at a crossroads. The S&P, look at this. I mean, When I say the markets are at a crossroads, the S&P is at the 200-day moving average. So when I say the markets are at a crossroads, I'm not joking around. They're in a crossroads between the bullish and the bearish phase. They're at the 200-day moving average. And I want you guys to be fully hedged. So join me today, 1 p.m. Eastern time. I'm going to go over this rotation strategy and give away my #1 sector play for the next 6 months. It's a low-hanging fruit. You guys are going to love it. I'm also going to be talking about the inverse yield curve. You guys do not want to miss out. It's all brand new presentation, 1 p.m. Eastern time, happening today. Do not miss out. Follow the link below if you're watching in the YouTube channel, Wealth Press YouTube channel. It's in the description if you can't find the link. Talk to you guys later. Have a great day. Send me some love letters. support@marketgeeks.com. Talk to you guys soon, and hopefully this will revert back higher and not lower. See ya.